Good day, fellow investors. Over time, there have been many comments on ULTA beauty company and whether I can analyze it because it is 29% down over the last few months. What's going on there? Is it now a buy? And many of you think it is down, it should go up, and I can make my 40-50%. But if you look at the long-term chart, this is what makes it interesting. It is a compounder with ups and downs. It is definitely a compounder. It has been over time. Therefore, note that. Very interesting business proposition. So, interesting business model. You probably know it if you are from the States, this omni-channeling beauty, but as it is a known company, we don't have to dig deeper into explaining, but I think I can add three simple things to your investment risk and reward analysis of ULTA Beauty. That is discretionary spending, where we are in that cycle. Always think about a recession, even if we haven't seen one for a long time. And when it comes to investing, great businesses always climb a wall of worry. Let's start with ULTA. So these retail differentiated business offerings, visionaries from day one, when they omni-channel offering, products, services, beauty experience, all things beauty in one place. And that has worked very well, as we have seen with the stock price. They have a broad store footprint. They increased the number of stores just by a few in the last year, but they are also expanding smaller scale in Target. They plan to start to expand in Mexico and then probably also go overseas. If the business model works, then this chart will simply continue to go up if the international expansion works as it has worked in the United States. As they say, one-of-a-kind services, omni-channeling. The market is pretty large if you integrate all those markets, and therefore they also have millions of members. This is more than Starbucks, keep in mind, on their app, which is then again a very interesting proposition. And they have delivered strong results post-pandemic. However, this is the discretionary spending that I want to discuss. So there has been that growth, okay, lockdowns, but this was an extra boost, then slowing down. And now you see these comparative sales have slowed down. Comparative sales are for comparing existing stores with existing stores, not new store growth. And there was this slowdown that also scared the market, and that's why the stock is now down. Also, if we look more in detail into the last quarter, comparable sales increased just 1.6%, thus there is something going on. If these comparable sales don't grow, then the business, as it is now, has reached its plateau, and the next step to growth is new stores, even if they are refurbishing, investing capex into refurbishing their own stores. But geographical expansion is now the key here. Compare that to potential slower discretionary spending. I think there has still been, and we still feel that exuberance of 2022, 2023, when everyone was flushed with money and everyone spent on these extraordinary things like it was normal, but now people start to feel that pressure of a little bit of inflation, a little bit of uncertainty, a little bit of, okay, this party might not be just continuing forever. And you see that here with the comparable sales, very strong decline. But the company is still there, still great, still making a lot of money, still repurchasing shares. So cash generation, 1.5 billion minus the capex of the refurbishing and everything. So 1 billion pure cash flow creation, 1 billion compared to the 18 billion market capitalization is a repurchase yield of a few percentage points. Let's round it up to 5%, not stellar, but then if this is a great business, then you will never find it extremely cheap. However, adding on the discretionary spending, this is the recession performance, the last recession performance that I could find for ULTA, and the stock was down 80%. Will there be a recession? Nobody can predict it. We haven't seen a real economic recession in the US for 15 years. So that's also something just to keep in mind when you assess the risk and reward of an investment. We know discretionary spending might slow down, recession might put more pressure on this. On the other hand, we have Mexico international growth that is still a big potential there if they can scale that. But when it comes to these great businesses, no debt, good margins, constant growth over time, those stories always climb a wall of worry. And the next worry now is Sephora from LVMH. So they are growing, expanding in the United States, expanding already being in Mexico. So this selective retailing from Sephora is now the competition, and increasing competition is always something that burdens big businesses. Some big businesses have always competition, narrow cafe, but they still manage to grow until a point comes where that growth is gone because of too much competition. When there are other replicants, McDonald's can continue. But the thing is that you never know as an investor when is that time of growth over. This is also the problem, and that is the wall of worry you need to know and see from a risk and reward perspective. At some price, the risk will be very, very low. However, is that price reached with ULTA? 5% profit yield on the current market cap is not a margin of safety bargain, because if they stop growing, then it's just 5%. That easily goes to 10%, and then your stock drops 50%. So I would say that now we are in a mid-risk, mid-reward situation. If they just keep on growing globally, there will always be issues there, delays. Maybe it will work, maybe the model won't work. Latin America, they say it's similar to the United States, so their business model could work there. However, you never know how that spending and the return on capital will be there, because the competition is already there. Sephora, okay, a little bit upscale. So that's what I wanted to add here. I don't think it's a value investment margin of safety. It's not cheap. Even if you would say a P ratio of 15, be careful with the P ratio. Look at the cash flows with these businesses, because depends a lot of depreciation. They're already refurbishing their stores. So look at the cash flows. The P ratio is 20 from the cash flow perspective, and that is already not cheap. 10, 12 for a great businesses, that's something that could be interesting. So I hope it doesn't go down 50% from here, but please notify me if it does. In case of a recession, slowdown, less investments into expansion, it will go down 50%. That's the risk. On the reward, yes, if they go back to growth, the P ratio will go to 30, and then you have a 2x, but that is a little bit stretched. Looking forward to more of your suggestions. I'm always curious to looking into new businesses and perhaps adding value from a differentiated point perspective. Thanks for watching. I'll see you in the next video.